we know, a partnership is not a separate legal entity. So consequently, when a partner leaves a partnership or a partnership admits a new partner, the old partnership ends and a new one is created. This is unlike a company which continues to exist even if the ownership of that company changes. When an old partnership dissolves and a new one is created, there are a few potential tax consequences. The first relates to trading stock. Alex, Bill and Cindy run a partnership which has trading stock valued at cost of $20,000. The market value of this trading stock is $30,000. What happens if they admit a new partner, Donna? Under Section 70-100, subsections 1 to 3, the default rule is that this reconstitution of the partnership means that the trading stock is deemed to be sold to the new reconstituted partnership at market value. As a result, the three original partners need to account for the $10,000 deemed profit on the trading stock. This could potentially negatively affect these partners. To prevent this unfair result, the deemed sale of the trading stock upon reconstitution can be at the same value as what the trading stock was valued at by the original partnership. So in this case, this would be at cost, and therefore there is no profit to account for upon reconstitution. We need to note, however, that this rollover only applies if the transferors elect it to apply, and the original partners still have at least a 25% interest in the trading stock after reconstitution. For this partnership, it originally had 3 partners and now has 4, meaning that Alex, Bill and Cindy are likely to still have a 75% interest in the trading stock, and so are likely to fulfil the 25% requirement, as long as they elect for this to apply. When a depreciating asset is sold, any excess over its sales price, over what it has been written down to, forms assessable income, or a deduction if the sales price is less than what it was written down to. When a partnership adds or loses a partner, there is a deemed sale of any depreciating assets. This potentially triggers a balancing adjustment. But similar to trading stock provisions, a rollover is available, meaning there will be no balancing adjustment. This rollover applies if the transferors and transferees elect in writing for it to apply. However, the most important tax consequence of a partner reconstitution is the capital gains tax implications. Ian, John and Karen run a partnership. One of the partnership assets is a piece of land they purchased for $150,000 a few months ago. This means that the cost base is $50,000 for each partner. The market value of the land is now $240,000, so each partner's interest is $80,000. What will happen if Karen leaves the partnership and is paid out $40,000 each by Ian and John for her share in the land? Unfortunately, unlike the trading stock and depreciation provisions, there are no rollover provisions to prevent a CGT liability occurring upon the reconstitution of a partnership. So, if a partner leaves, the remaining partners acquire that departing partner's share of assets. This means that the departing partner is potentially subject to triggering CGT event A1. So in our example, Karen leaving the partnership triggers CGT event A1. Her cost base is $50,000 and capital proceeds are $80,000, meaning her capital gain is $30,000. The 2 remaining partners, Ian and John, have not triggered a CGT event, but their cost base has now changed. They used to own 1/3 of the land each with a cost base of $50,000. Now they own 50% each, and so each has a cost base of $90,000. What about when a new partner joins? Edith and Fred run a partnership, and the only asset is a piece of land they bought together 8 months ago for $240,000, meaning they each have a cost base in the land of $120,000 each. The market value of the land is now $300,000, $150,000 for each partner. They introduce a new partner, Greg, who pays the existing partners $100,000 for a 1/3 interest in the land. If a new partner joins, 2 things happen. First, The new partner is taken as having acquired a share of each partnership asset. And 2, the existing partners are taken as having disposed of part of their interest in each partnership asset. This is likely to trigger CGT Event A1. So for Edith and Fred, there are 2 consequences from introducing Greg as a new partner. Firstly, Greg has acquired a 1/3 interest in the land. This is not a CGT event, though if the land is subsequently sold by the partnership or another partner is introduced, then this will be relevant in calculating Greg's CGT liability. And secondly, Edith and Fred have both disposed of part of their interest in the land. This does trigger CGT Event A1 for each of them. They each used to have a 50% interest in the land, and now they only have a 33.3% interest each. Therefore, their interest is 66.6% of what it was prior to the reconstitution, meaning they have each disposed of 33.3%, which is 1/3 of their original interest. As a result, each of them has a capital gain of $10,000. As they each disposed of 1/3 of their interest in the land, and for each, the capital proceeds of the disposed portion will be half of the $100,000 received.